And we should be live. Welcome to Thoughtful Money, everybody. I'm Thoughtful Money founder and your host, Adam Taggart. Welcome you back here for everybody's favorite video of our 2-week bi-weekly schedule with the wonderful macro maven herself, Stephanie Pomboy. Hi, Steph. How you doing?
I'm awesome. How are you doing, Adam?
I'm doing great. Running a little bit ragged this morning, hence the hair that's still wet from the shower, and are starting about a minute or two late here. That's on me, folks. But very excited to catch up with you, Steph. There's been a lot going on. Right before we turned the camera on, we were sort of sharing our different headlines for today's call. And mine is cracks in the economy are beginning to show. Yours was Fed falsehoods. Did I remember that correctly?
Yes, correct.
Okay, so why don't we start there? So folks, I've got some questions for Steph about some of the things that have happened, the many things that have happened since her last appearance 2 weeks ago. And then we'll open up the questions to you, the live audience, in the back half of this discussion. But we've had a lot going on with the Fed. I think I was interviewing Danielle DiMartino Booth the other day, and I said, there's more drama in curveballs than a World Series tiebreaker here, because we've had, Jerome Powell come out with the Jackson Hole speech, basically tell the world, yeah, we're going to start cutting. And then we've had all the drama in terms of staffing replacements at the Fed, whether that's who's going to replace Powell himself when his term's up next year, the replacement of Kugler on the FOMC, and now all the drama over Fed governor and FOMC member Lisa Cook. The last, development on that was that Trump actually sent her a letter saying you're fired, and then she said, "No, I'm not." So we're going to see what happens there. But a lot going on, and even questions being raised, Steph, by Trump and Secretary Bessent on, hey, just should we revisit kind of how the Fed works too?
Mm-hmm.
So it's not just the chairs at the Fed that might be getting new people in it, but potentially we could, see a revisitation of the actual structure and operation of the Fed. So a lot going on there. Where do you want to start?
Well, I guess since our whole objective here, not to be crass, is to figure out ways to make money in the financial markets. I would like to start with why this whole Fed thing matters. And in my view, just for background for people, when I started Macro Mavens, my sort of self-imposed mandate was to identify where the market was mispricing potential outcomes related to the economy. So I would analyze the economic fundamentals and sort of look at how the markets were pricing in the economic glide path, whether it was, anticipating stronger growth or weaker growth, and sort of analyzing the assumptions built into the market, and then going back and looking at the data carefully to see if they supported those assumptions or not. And by identifying areas where the market assumption appeared to me to be straying from the actual direction of the data, I was able to identify both risks and opportunities for my clients. So that's sort of just a general background as to my approach, which admittedly is a fairly antagonistic approach. And it's why, I'm constantly tarred as a perma bear, because the market narrative always seems to be bullish, and my job is to identify where that bullish narrative might fall asunder. And it's not necessarily always related to the market overall. It could be specific sectors. Like, I identified the housing bubble and everyone was bullish on that. And clearly they missed what was happening and then the knock-on consequence for the financial sector. But that's all ancient history. Moving forward to today, the reason why this whole Fed, drama, as you put it, is so crucial is that ever since the Fed actually started tightening, let's go back to 2022, when the Fed began to raise interest rates, we saw the markets, recoil in a reaction to that initially. And then it wasn't too far into the tightening cycle that investors began to anticipate the pivot, because the average investor alive today has only ever lived in a time where the Fed put was in place. So, the higher they raised the Fed funds rate, the sooner and more dramatically they would ultimately have to reverse it. And that was the market assumption. And it's been a good assumption for years and years and years. The problem is that they started making that bet, I think, at the end of 2022. I mean, Fed was, raising rates starting in March of 22. And by the end of that year, the markets were basically saying, yeah, you can keep raising rates, but we're going to ease because we're already anticipating the rate cuts because you guys always get it wrong and you're going to end up panicking and reversing. And so we basically had the better part of, 2.5, 3 years where the markets have been doubling, tripling, and quadrupling down on this bet that the Fed is going to cut rates. And as we saw when they finally cut rates last September, they didn't get the reaction that had been anticipated. And I guess, that kind of was masked by, at the time, this is very clever on the part of the previous administration, targeted fiscal stimulus that was kind of designed to unfold precisely going into the election.
Right.
So you had this different reaction than anticipated around Fed rate cuts, but it was sort of offset by this economic stimulus coming from the fiscal side of the equation. But we come into this year, and again, investors are sort of tapping their fingers, waiting on the Fed rate cuts. And I, as I've been saying forever, very broken record on this, am highly skeptical that they'll get the results they're anticipating. And a lot of that is built, obviously, on the massive explosion in our federal debt over that interval, that post-COVID period. We've kind of entered what people term an era of fiscal dominance. And I think that is going to become a real obstacle to getting the long end of the curve lower. And, just weaving it back, this is very big picture stuff. But if that operating assumption that once the Fed cuts rates, the long end of the curve and, corporate credit and mortgage rates and everything tied to it will come down, is called into question, then basically the entire foundation of the rally in risk assets, be it equities or corporate credit, private debt, et cetera, is going to crumble. And that obviously has massive consequences. And we can get into all of those, both related to the markets, but also back to the economy. But that's sort of a broad overview of why I think this whole discussion about the Fed is so interesting and mostly misses the point entirely.
Okay. Well, like any good interviewee, you already answered several questions I was going to ask you. No, it's great. So as the Fed starts bringing down the policy rate, you don't necessarily think that's going to start bringing down the long end of the curve for the reasons that you just mentioned. Let me ask you this, Steph. And I want to ask you in just a moment sort of where you think inflation is going to head. So keep that in mind, because to a certain extent, bond yields are a function of inflation expectations. But let me ask you this: what do you think is a more likely trigger for bond yields to start coming down? I get the sense from you it's not because the economy's growing again and everybody just starts thinking, oh, okay, everything's solved and good, and we're going to start taking the risk premium off ourselves. Though if that's your default expectation, let me know. I think it's probably more a combination of either things get so bad with the bond market, bond vigilantes, if you want to call them that, driving things higher, that the Fed actually has to step in and start performing some sort of operation twist or QE, outright buying. So is it that, or is it that the economy slows and then starts slowing so much, maybe contracting so much, that people start freaking out and you get the safety trade of people saying, hey, look, I don't love treasuries, but they're still probably the safest asset out there on the block. I'm going to go into them.
Well, I think it's a question of timing, because I think both of those answers are correct. I would place them in a different order. And I would say that the first thing, if there's an impetus for a rally at the long end, and I think there is, I'm not ruling that out. I'm just saying over, the medium to long term, the path of least resistance for Treasury yields at the long end is higher, not lower. But in the near term, as this confidence that the U.S. economy has escaped recession and is now, going to start hitting on all cylinders, courtesy in large part of this productivity boom led by AI, et cetera, and these trade deals and so on. As that's called into question, there is a massive speculative short position in the 10-year and the longer dated treasuries, not just the 10-year, 30-year, et cetera. So hedge funds,
squeeze.
Yeah, hedge funds basically are sort of share the view that I outlined at the top, that it's not clear that the long end of the curve is going to move lower as the Fed cuts rates. So there could be a massive short covering as the economic data comes in weaker, and they're forced to acknowledge that the economy may actually go into recession. I was looking at this the other day. The forecasts of recession here in the U.S. have collapsed in terms of Wall Street, sell side forecasts. They were substantially around April with Liberation Day. It was the majority of Wall Street brokerage firms were forecasting recession, and today basically no one is. I actually did a search of Google Trends, where you could look up how many people are looking at certain words, searching for certain things. So I entered recession in there, and it's flat on, it's almost as low as it's ever been. And just for giggles, I thought, let me think of something else that nobody is focused on at all anymore. So I typed in, and this is not a political thing, but Kamala Harris, because she's just completely disappeared from the entire, discussion whatsoever. And she actually rates higher than recession in terms of Google searches. There are more people searching for Kamala today than recession. So I thought that was a pretty cogent illustration of just how confident the markets have become that scenario has been, swiftly averted. So anyway, that's the short-term risk, is that we see some deceleration in economic activity that precipitates a short covering by these hedge funds. And I guess longer term, as you and I have talked about many times over, I do believe that a resistant, let's say a stubborn long end of the yield curve will invite the Fed to come in and institute some form of, whether it's yield curve control or QE or whatever they want to call it, Operation Twist, as you said. They'll come up with, some newfangled term for it that sounds fairly innocuous. But they're going to end up having to do that. Because I think, as we talked 2 weeks ago, I had sort of dazzled you with the average interest rate that the Treasury is paying on all the debt outstanding, and it's 3.35. A rate that exists nowhere on the you can scour your Bloomberg terminal, and if you can find it anywhere, I'd like to know. But so clearly, they're going to have to be, our interest expense is going to soar as all the debt coming due is refinanced at substantially higher rates. So the Fed is going to have to get involved, and that's why, I've long, again, broken record on this one. I think all the focus on the Fed funds rate misses the point, because all of the action is going to take place on the balance sheet, because the Fed funds rate is going to prove to be an ineffective lever.
Okay. So a number of things wrapped up in there I want to talk to you about. Just to make sure I heard you correctly, though, I think I got everything except I didn't hear you mention one thing. And so let me just make sure I get that. So in the short term, you expect, I think, the risk to the economy is to the downside, right?
Yes.
And you mentioned that there may eventually be a short squeeze of all the Treasury shorts right now. Do you see that because folks realize that yields probably aren't going higher anytime soon, and so they're gonna squeeze, or is it because the economy is slowing to the point where the markets start correcting? Like, oh, you know what, we got to reprice here because we weren't, we were pricing things too richly. And then as this, the safety trade starts coming into treasuries, pushing treasury prices higher, that's the trigger for the squeeze, right? And then those guys get squeezed out, prices go even higher. And because the markets are correcting, and this is the question ahead for you, do they get to a pain point where the Fed then steps in rescue mode, right? Mm-hmm. And that then gives the Fed the green light for the Operation Twist, for the QE or whatever they're going to call it.
Yeah, I mean, there are a number of things that could be a catalyst for that. Obviously, not just the headline stock market indices going lower, but we could easily have a problem surrounding that opaque world of private credit. And that, the insurance companies are big participants in that market. Then you can get into an issue of counterparty risk, which hits on derivatives. And so, this is the scary thing. And the Fed is afraid as well because they have no visibility into that area. And
so I'm just going to interject with one thing because I want you to continue, but I just want you to include this in your answer. So to your point about recession and, nobody's thinking about it, even fewer people are thinking about it than Kamala Harris these days. I just want to put up this chart by Charlie Biello about one of your favorite topics, which is credit spreads. Yeah. So right now they are so tight that he's saying they're the tightest since 1998, I believe. Yeah, July 1998. Yeah. So investors are reaching for yield and behaving as if there will never be another default cycle again. So right now, nobody is concerned at all on the credit side. So to your point, there's lots of potential pins out there that could force credit spreads to start widening. But right now, no one's worried about them.
Yeah, there's tremendous complacency. And I guess the ultimate point that I would get to with this is that the world of private credit is still highly intertwined with the conventional banking system. And that is where the Fed might feel the impetus to come in and provide some, massive rescue / bailout, because it could very easily come home to roost on bank balance sheets, given the lending that they're doing to a lot of these private equity firms, venture firms, leveraged loans, et cetera. So it's not as though the conventional banking system doesn't have significant exposure to all these highly illiquid, high risk assets that, as you note, are priced for absolute perfection. So I think that might be the impetus. I still struggle, though, with the risk of, with the idea that you're going to get a material decline in long rates, even as credit risk is unwound or repriced and equity markets, revert to some semblance of reasonable valuations. Because people will eventually, I think you'll have that initially. It's just a Pavlovian response, slower economic growth, deflating assets, fly to safety, which is US Treasuries. But it won't be more than probably 5 minutes after that takes place that people say, wait, is it safe to be in US Treasuries at a time when we already owe 37 trillion and we're now entering an era, a phase where monetary and fiscal stimulus will be brought to bear on rescuing the whatever it is, the financial sector, the housing market, whatever it is. And so, the math will ultimately prove ineluctable. You can't avoid the math. And as the deficit forecasts mushroom, I think that the rally at the long end of the curve will be swiftly brought to an end.
Okay. Hence your continued position in gold.
Yes.
I'm guessing because you think, hey, if the equity markets are correcting, but folks aren't feeling as good as they have in past cycles about bonds, where do you go for safety?
Yeah, absolutely. And I have recently, just because, again, I get tarred as a perma bear and I'm missing everything. And of course, in addition to people who view that I missed Bitcoin because I bought gold, that people, there's this view that, well, you missed the rally in equities that's being driven by AI. Aren't you current? Don't you understand how important AI is going to be? And I do, but I come back to the question of valuation. And if you love AI and think it's the, going to redefine our future, then you have to love energy. And when you look at the comparable valuations, you want to buy energy all day long because it's in the basement, and the AI stocks, until just recently have been absolute juggernauts. So again, it gives me this optionality, let's say, where I'm effectively betting on the AI boom, but I'm doing it through hard assets, and I have that protection against the forthcoming dollar debasement.
Well, so it's almost, in my opinion, you're doing a double whammy, which is it's that, but then it's also buying an asset that seems to be underpriced versus via
Yes,
its fundamentals
right.
versus, who knows exactly how to fairly value these AI companies or the Bitcoins of the world, but hard to argue that they're not at speculative highs right
Yeah,
now, right?
yeah,
So, yeah.
absolutely. I mean,
Okay.
even Sam Altman said that, so you don't need to
Yeah,
take my word
exactly.
for it.
Great point. Yeah. When basically the poster child for the space
Right.
says we're in a bubble. Yeah. Yeah.
Yeah.
All right. So I do want to ask you about inflation again in just a second, but real quick, if you had to bet on a horse race, for what is going to be the trigger of the repricing, in
Credit market.
the trigger that's going to cause a repricing in the markets, the type of downward repricing we're talking about. What would you put your money on more? Would it be the cascade of consumer debt contagion, potentially triggered by student loan repayments that we've talked about, where the consumer's getting more stretched, but they now have to pay those student loans that have gone into repayment, and therefore they have to start skimping on the other forms of consumer credit, and that thing just sort of dominoes its way through the system. Or is it the private credit risk? Which
I
one
mean,
worries you more?
well, I mean, they both worry me,
I know they do.
probably in equal amounts, although there's substantially more leverage around the private credit side, and then, more levered exposure to the financial system. But I guess as I think about an actual trigger, I'm thinking September 18th. That's when the Fed meets and they're going to cut rates. And I would expect, at that meeting, as we saw last year, once they cut rates, that's when the 10-year and the rest of the curve will start to march higher. That will be really a rude awakening for investors, because, again, it just destroys the underlying assumption uh, of both equity and credit investors that they're going to get credit relief. So I guess that's, more than anything, because all of those things that you talked about, the consumer uh, distress, corporate distress, and we've seen, a huge increase in corporate bankruptcy filings, ratings downgrades. We've seen the consumer distress bleed from first a subprime auto to credit card and now mortgages as the student loan payments are resumed. All those things seem to have been unfolding, you know, every day they get a little worse. It's just this slow and steady deterioration. And it's been glacial enough that Wall Street, focused entirely on this Fed rate cut, has been able to kind of ignore mostly. So I think that that really is the thing. What's going to change? Or do we expect the consumer or credit distress to suddenly, out of the blue, get substantially worse? I don't think so. I think it's going to be a repricing of risk appetite, let's say a reduction in risk appetite, that precipitates the real sell-off in all of those things. It's just going to be challenging that assumption that lower treasury yields will bring down rates across the entire economy. Because if treasury yields aren't going lower, what's the impetus for further tightening of spreads? As you showed that chart,
Right.
can they get any tighter? I mean, maybe we could have the two AAA companies that are left trade cheaper than, borrow cheaper than the US Treasury. Maybe. I mean, we could
I
get to
guess
a
if they
place.
started paying you to borrow their debt, sure.
Yeah, exactly. So,
Okay. So in your mind, you're really looking at the next FOMC release, because that may be the sell the news event after the rumor has been bought so long and so hard, right?
yeah, the one caveat to that is there's been a lot of chatter recently about this notion that they're teeing up a rate cut in September, and that could be one and done. And so I think it'll be interesting. And a lot will depend on the tone of the presser after the cut, because I think at this point, what are the odds? 90 some odd% that the Fed's going to cut. And then the question that remains to be answered is, then what? And, the markets have, it seemed like in the last couple of weeks kind of reduced their idea that this is going to be the beginning of a we're cutting every meeting type of easing cycle.
So I haven't looked today. I thought that rates cut expectations for the rest of the year jumped up after Friday, right? Where so if that's not true, then please correct me here. But from what I took from Powell on Friday was basically Powell saying what I think a lot of analysts, I guess we'll say, we're expecting, maybe not a lot of investors, but because investors, they've been, to your point, they've been waiting for Powell to come to the cutting table, and they're probably feeling pretty validated. But Powell, for pretty much this entire year up until now, when pressed uncharacteristically aggressively, in my opinion, by the press corps at his conferences, was saying like, no, I'm really not that worried, folks. It's not that bad. It's pretty good. Everything I'm looking at is still pretty good. I'm basically holding back because we don't know what the inflationary aspects of tariffs are going to be. So I don't want to cut too early. But if I look at the jobs market, yeah, it's cooling, but I call that normalizing. We're not seeing anything there that worries us. This is all perfectly normal, folks, right? And it's his job to project confidence, but I mean, that's what he'd been doing right up until Jackson Hole. And then at Jackson Hole, he said, whoa, you know what? Like, this jobs market's cooling more than we thought it was going to. Ooh, there's some things in the housing market that are going on that now have our attention. So it really seemed to me that he cracked open the door to, okay, I'm not cutting now because I'm less worried about tariffs. I'm cutting because I'm now more worried about my other mandate.
Right. Yeah, no, it does seem like the focus shift to the employment side of the mandate, and with good reason, after those staggering revisions that we saw to the payroll numbers. So, I guess he kind of had to acknowledge that the Fed had been looking at data that was leading them to a false conclusion, and they frankly were just ignoring all the other employment indicators that were telling you that the labor market was anything but as tight as the establishment report was telling you.
Yeah. So I guess my point is, I just think the data is going to be in the driver's seat for the next couple of Fed meetings. Like if the employment market visibly starts getting worse, I don't see how they don't keep cutting from here. Yeah.
Oh, absolutely. And I guess, days feel like months right now, Adam, so because there's so much news. So you're talking about like last Friday as the Jackson Hole, and it feels to me like that was a month ago. And so when I characterize this shift in thinking about whether September would kick off a string of rate cuts, that actually, I guess, has just materialized over the last couple of days, more so than it's subsequent to Powell's very dovish or surprisingly dovish presentation at Jackson Hole that got everyone so enthusiastic. And then I think you've seen some of that pared back subsequent on the idea that, yes, we'll have September. And then, as you say, it's really going to turn on the data. It wasn't a idea, as he keeps underscoring, that Fed policy is on a preset course, and that once we kick off, we're just going to be cutting. So I think that, it does feel like it was weeks ago, but it was actually probably only 2 days ago that started. Apologies. It's coming, it's like you say, drinking out of a fire hose around here.
Yeah. And, if the data continues to worsen and the Fed is forced to, cut and sort of chase the economy downwards, that would be the exact pattern we've seen the Fed follow over the past, 50 years? It would literally be no different than what we've experienced, right? All right. So inflation, I just want to, I think I know your answer to this, but the CPI has, been nudging up in some of the recent monthly reports, some of that due to base effects, some of that, potentially due to tariffs. Obviously, this year, this has been the biggest point of disagreement between the experts that I've interviewed. Some have said, look, we're in a new inflationary regime, and man, tariffs are going to totally, pour gasoline all over that. And then a bunch of others who have said, no, the economy is going to slow, and that's going to be, and it's going to put disinflation in the driver's seat. What do you expect from here, say, over the next 6 to 12 months?
Well, as you and I have talked about a lot,
I
you know,
know.
when we look at the consumer, the wherewithal to absorb higher prices is about as low as it could possibly get. You know, after suffering this huge increase, this stair-step increase in the price level, um, you know, post-COVID with the stimulus spectacular that took inflation, measured inflation up 9%. I'm sure actual inflation was well into the double digits. And importantly, even though the rate of change has come down to whatever, the price level has just continued to move higher. So there's been no relief provided to Main Street, even though the Fed is taking a victory lap on basically reining in inflation. So their capacity to absorb, this was my whole problem with the tariffs or inflationary narrative. Is that where, you know, consumers just, they're already showing signs of massive distress, as you talked about. You know, it's not for nothing that the delinquency rates, you know, on credit cards and auto loans are the highest since the Great Recession. So,
And
and
increasing. The momentum's still to the upside on those. Yeah.
exactly, and now we're pulling in mortgages as well. So, there's no indication that the consumer is suddenly feeling better and has better wherewithal to absorb higher prices. In fact, I saw an article the other day, I wish I had, you know, drilled down to it. I think it was a report on CNBC that was talking about recession specials at certain restaurants around the country, and that was kind of making a comeback, which is
Mhm.
interesting because it's happening at the same time, as I mentioned earlier, that Wall Street has concluded the recession is completely off the table. And
Yeah.
yet you're seeing restaurants around the country trying to lure back sort of, you know, strapped consumers with offering these specials. So that was my real concern about this narrative that tariffs would equal headline inflation. I always thought it wasn't an inflation story; it was a profit margin story because yes, the cost of imports is going to go up, but your ability to pass that price increase along to consumers is going to turn out to be fairly limited. So we've already seen, you know, several analyses that show that consumers have absorbed a very small portion of the total tariff hit across the board. You know, a lot of it has been absorbed by the exporters themselves or by the companies importing here in the US, with precious little of it passed through to consumers. And the areas where it has been passed through to consumers are the areas where they really have no choice but to pay for those things. And it is therefore causing disinflation in the things they can live without.
Yeah.
So I think that, you know, my outlook for CPI inflation isn't substantially lower, but it's not higher either. I kind of see things kind of moving essentially sideways in this churning sideways channel. But I think the PPI here is the thing to look at. And we've already seen a substantial, you know, turn higher in that. And then if you look at things like the regional Fed surveys, that manufacturing surveys that talk about prices paid versus prices received. And I'm thinking specifically the Philly Fed Manufacturing Index, storing prices paid, almost no change in prices received. And that implies obviously a real margin squeeze.
Yeah.
Um, Also, if you overlay those prices paid numbers, not surprisingly, those indices with the PPI, they tend to lead. So it does sort of presage further increase in that input inflation, the PPI, and time will tell how much of that then gets passed through to the consumers. But as I just mentioned, you know, those are my reasons why I think very little of it will. And that just brings you to another headline risk for the equity market. Is this, it's interesting. When we started the year, the consensus estimate for S&P earnings for 2025 was 12.5% growth. And that going all the way into Liberation Day, went to 7%. So they immediately, once the tariff rollout began, the sell side analysts began to fret, you know, well, earnings are going to get clobbered by this. And in the couple of months subsequent, they've taken earnings forecasts all the way back up to almost 10%.
Mhm.
So Again, underscoring this idea that we're out of the woods and that corporate pricing power is going to remain fine. Profit growth will be robust. And then all we have is gravy on top with Fed rate cuts. So buy,
Yeah. So you're taking the under, obviously,
Buy.
on that.
You think?
Yeah. So just to make sure that I'm characterizing your view accordingly, you got a consumer that really can't afford to pay higher prices. So much of the tariffs, at least so far, but you're guessing going forward, at least in the short to midterm, will be eaten by the exporter and the importer. Now we were starting this process from kind of at or near record profit margins. Now that's an average, but it does show that, okay, corporate America's got some fat to cut here if it needs to. But for all the reasons you just mentioned, that will equal compression on corporate profit margins. And if that gets big enough, well, first, Wall Street's going to have to revalue those stocks, right? So that's going to bring down stock prices, which, places additional issues on these companies. But, profit margins get squeezed enough, well, companies have to cut costs. And so that's probably going to equal more job losses, right? So, all right, we got a poor consumer who's already strapped, but then some percentage of them lose their jobs. Well, then consumer spending then goes down. We're still a 70% consumer-driven economy, so therefore profits get squeezed even more, right? So that's kind of, but that's sort of what you're concerned about here, right?
Yes, and then layer on top of that, as earnings estimates are brought down, presumably the outlook for credit quality will be revised as well. Your ability, if you're running a company and your earnings growth suddenly gets cut in half, your capacity to service high cost debt is further compromised. So you could layer in there on top of that an expansion of credit spreads that drives up borrowing costs, which further dents profits because you're suddenly apportioning more of your money toward interest expense, which further depresses, there's a lot flying around in that feedback loop that could accelerate it big time.
Okay. I won't get into it in depth here, Steph, but if you haven't watched it yet, I'd recommend you go watch just the 5-minute part of the interview I did last week with Steve Hanke on inflation. There's a lot there he says that's, I think, corroborative of your point of view. I don't want to say you guys look at the world exactly the same, and actually tariffs and their impact and who pays for them. It's actually, I think you guys have somewhat of a difference of opinion there. But one of the things he said that really I've been noodling on since is, so M2 has been increasing, money supply has been increasing. And a lot of people say, well, that's your inflation right there, right? Like, we're going to have higher prices because M2 is increasing. Now, Hanke lives and dies by the quantity theory of money formula. And basically by his calculations, the money supply needs to be increasing at least 6% to keep the CPI at 2% or above. Okay. And right now it's growing at 4%. So even though money supply is growing in his calculations, it's not growing fast enough to create inflation that's going to push CPI long-term above the Fed's 2% target. So he expects disinflation from here. And it could drop below 2. He's not really worried about deflation right now, and he doesn't think it'll come that far below 2.0. But it's an interesting, very academic and formulaic outlook at it, and I think you'd be interested in it. And obviously everybody else who might be interested hasn't watched that yet, go see it. Okay, so
if I can add just a comment on that. Obviously the money supply measures are important because that's the tinder for inflation. But I think ultimately you can't analyze that in a vacuum because velocity of money is the key. So you could pump money into the economy at a time when no one wants it, as we saw at the depths of the global financial crisis, when the Fed was pushing money into the financial sector and they just wouldn't do anything with it because they were so curled up in the fetal position. So the velocity of money is a crucial part of the inflation outlook. And you can't just look at, and I'm sure he doesn't, so I will look forward to, hearing his full analysis, But you can't just look at, and I've seen a lot of people on Twitter point that chart of M2 and say, here comes inflation. Well, not necessarily. That's a necessary but not sufficient condition for inflation. You need both. You need money supply growth and velocity growth. In fact, you could have zero money supply growth and massive growth in velocity and have inflation.
And still have inflation, exactly. And that's why V is a critical variable in the quantity theory of money equation.
Exactly.
Yeah. Okay, so I want to still chopping our way to the key question of today, which is, what do you expect the Titanic impact on the economy to be of the Taylor Swift engagement? But we're getting there, so don't worry.
I don't even know what team that football player plays for, so I'm completely lost on that one thing. And I would say that with pride. Not about the football thing, but about Taylor Swift. I couldn't name a song.
Well, you clearly don't have two daughters like I do.
I'm a punk rocker. I am not a Taylor Swift girl.
That's right. Yeah, you're a Ramones girl, not a
exactly. Or Black Flag or Suicidal Tendencies, whatever. Take your pick, but not Taylor Swift.
Wow, I think it would be hard for folks to assume that your stock could go even higher amongst my audience here, Steph. But I think we're going to find out in the live chat here in a moment that it just did somehow. All right. Well, let me just ask you this question, which my brain comes back to from time to time, just sort of stymied by it. So back to that credit spreads chart. Look, it'll probably be some black swan, as it always is, that creates the phase change here. It'll probably be somebody that breaks under these issues that you're talking about that nobody was expecting to break, right? But there are plenty of white and gray swans around here that we can talk to, and you've pointed out a whole bunch in this discussion. What is keeping credit spreads so low? Why are they acting like absolutely nothing bad, major or minor, could happen from here?
Well, I think there is an incentive on the part of the lender to maintain this sort of placid environment. Let's put it that way. We've seen extend and pretend go into innings that I never thought we'd see. I mean, and I'm not even just talking about publicly traded corporate credit, bonds and levered loans, et cetera. But I'm thinking when you look at these continuation funds that are being launched now by private equity for portfolio companies that are so dead in the water, these zombie companies that they're throwing off zero income to the investors. And now you've had a debut of CV Squareds, which is a continuation fund. It's the second round. So I think that's it, is that it's essentially a visualization of the doubling, tripling, and quadrupling down on this bet that the Fed's going to cut rates, and that will provide relief to companies that are currently just scraping by, and they're only scraping by the mercy of their creditors. What do they say? When you owe the bank a small amount, they own you, and when you owe them a tremendous amount,
when you owe them $1 million, you're in trouble. When you owe them $100 billion, they're in trouble. Yeah,
right. So this
is basically just trying to keep kind of the Ponzi alive. Like let's try to keep people from dying and creating a cascade here.
Well, what you don't want to do is create visibility. You don't want to have a pricing event in that market. So you'd rather sit on your hands and extend and pretend and kind of keep throwing money so as not to have to mark to market the true value of these loans. And so I think that's the game going on. And they're scrambling, as I said, to raise the money to continue the extend and pretend by doing, funds of funds, but also, and we've seen it recently, this debut of retail ETFs, which is essentially designed to, have the retail investor be the patsy for all this stuff. It's a convenient way to offload these things. Yeah. So we're really, as I said, kind of pushing into the innings, overtime here. And I think, again, this all will turn if and when the Fed cuts rates and the markets don't get the reaction that they anticipated.
Okay. Look, I mean, a lot of people would point to the credit spreads and say, look, nothing's wrong because Wall Street's
Yeah.
telling us it's not concerned. I think you would say, and this is kind of what the vibe I'm getting, which is it's so unnatural that we should actually look at it as a danger sign,
Yeah.
right? Yeah.
Absolutely. And again, I think the fixation on spreads, people point to that, like you're saying, as well, corporations are borrowing at these tight spreads. Well, look at the nominal yields they're borrowing at. That's the key. Who cares? They don't care. XYZ corporation doesn't care that he's borrowing at only 200 basis points above what the federal government's borrowing at. He cares that his rate went from 4 to 8.
Exactly.
So it doesn't matter to him that suddenly he's not paying as much relative to the federal government. All he knows is his, interest cost has doubled.
Yeah.
And that is the situation today. So I think that's another area where the complacency, people like to look at spreads. And I've been in plenty of meetings with sophisticated, institutional investors who pull out that chart and say, what are you talking about? There are no problems.
And that is the key point, is it's while credit spreads really do matter generally as a sign of I guess risk in the market, stress in the market. But what really matters here, which you and I've talked about ad nauseum, Steph, is the step function, right? It's this rolling maturity wave that companies, as they hit their maturity, their interest costs, their debt costs go from here to way up here.
Yeah, and you're reminding me that I need to update this chart, but I had done a chart looking at corporate bankruptcies relative to credit spreads. And not surprisingly, they tend to move together. And the exception, the blaring exception, is the current environment where you've seen this spike in corporate bankruptcy filings, by some measures back to the highest since the financial crisis, and spreads moving swiftly in the opposite direction. So,
I'd love to see that chart.
Yeah, I'll have to update that and I'll send it to you to share. But something's going to give. Either the bankruptcies are going to collapse or spreads are going to move substantially higher.
Right. Which, a collapse in bankruptcies isn't going to happen unless we have this magical return to sunshine and rainbow growth anytime soon, which we'd all love to have happen. But the probability of that way lower than these credit spreads having to start reflecting the reality on the ground. So place your bets accordingly, folks. But
unless, of course, all the zombies die and then there are no other companies to file for bankruptcy. Sort of like the unemployment rate. If everyone just left the labor force, we'd have zero unemployment. So
right. Well, if all the zombies died, I suspect there's an awful lot of them out there, and that would be a lot of jobs lost. So,
Well, we've seen a lot already, but there's a lot more behind that for sure.
Okay, so two other questions before we get to the really big one. So housing. So you mentioned, we want to talk a bit about housing. I've had some long discussions recently on this channel. Ivy Zellman, and just a few days ago, Melody Wright, and then just yesterday, Danielle even wanted to throw her hat in the ring. We talked about, so I've been talking about housing nonstop for the past week.
Sorry to hear that.
No. I mean, look, I could talk about it. I could talk about it forever. But
so you're going to get your fourth female opinion on housing.
It's been a great week. It's really been a great stretch this week. I realized that, it's sort of like a reversion of the mean, because I remember like a couple of weeks ago being like, oh, besides Stephanie, I haven't had that many women on the channel recently. And then just boom, we've had this great bounty, which has been wonderful.
Power.
Yeah. But what in particular has been catching your attention about the housing market of late?
Well, I think a lot of interesting things. When you look at the deterioration in a variety of indicators, it's pretty staggering. And one that sticks out is the cancellation rate on home sales. I think that hit the highest level. The people who measure it only have data back to 2017, but it's the highest on record in the latest month. So that's not a positive indicator. The other thing that I have found interesting is that for the first time in this cycle, we're seeing a huge increase in home equity cash outs, which I view, not surprisingly to your audience, as a sign of consumer distress. where, they're now reaching the point where they're having to tap equity to keep up with their rising debt service. And maybe it's been precipitated in some part by the the resumption of student loan payments. But whatever the reason, it's definitely a red flag coming at a time when you're starting to hear the air hissing out of the housing bubble rather clearly. You're definitely seeing price deflation in a lot of key markets. And contrary to the popular perception that we are underhoused, we have this wall of supply, both under construction and completed, that as it makes its way to market will further depress prices. I mean, the gap between the affordability of purchasing versus renting is the highest on record. So that definitely suggests you're going to have some reversion to the mean. And that will be accomplished, I suspect, not by rents moving higher, but by home prices moving substantially lower. And you won't be surprised to learn that I think the impetus for that will be when the Fed cuts rates and mortgage rates don't move lower.
Exactly. Yeah. And you get a lot of seller capitulation.
Yes.
So I agree with everything you've said. It's very consistent with my previous conversations with previous folks, particularly Melody.
Those are smart ladies, and I like to be in good company. So
you're in very good company. I was watching some YouTube videos yesterday on some real estate channels, which were, realtors and home sellers, just in agony over their plight. And so for the realtors, it was that they're kind of at the point where they're starving, right? I mean, transaction volume has been so low. But also to your point about cancellations, they're complaining about houses that were on the finish line, and then the transaction got skunked one way or the other. And then you had the home sellers saying, like, oh my God, we did all this stuff. And then the person backed off, right? And it's a lot of talk amongst that crowd. I mean, just the realtor crowd itself, about capitulation, seller capitulation, that's what it's going to take to start clearing this market, which, I've been saying with folks like you for a long time now, but it sounds like the actual market itself, the realtors and the vanguard of the sellers are beginning to realize, look, we hoped we could make it through to 20, there used to be stay alive to 25 because that's when rates were going to be lower.
Right.
Right. So I think they're realizing the cavalry is not arriving. And to your point, everybody's got their hopes now on the Fed cutting. And if the Fed cuts, and to your point, mortgages don't come down notably, I think that's when it's be like the final stake in the heart. It'll just be like, oh, Jesus, I got to get out from under this thing. So whatever it takes, bring the price down.
I mean, I'm so relieved that I sold my house, and I was in a market that is still hot, West Palm Beach area. There's still a huge, influx of people. And I presume that if this mayor candidate in New York actually gets elected, this Mamdani,
you'll have a lot more. Yeah,
there'll be a lot more. But nevertheless, it feels good not to be long real estate right now, because for all the reasons you just suggested, it just seems like I can hear the air hissing out of that bubble very loudly. And that's also has obviously massive implications for the outlook for growth, not just for, credit risk specifically related to mortgage delinquencies, et cetera, as homeowners find that they cashed out equity that suddenly evaporated. But the multiplier effect on housing is huge. And I was just looking at the Atlanta Fed's, updated estimate, which came out yesterday for 2Q GDP, and they have residential housing declining over 8% in the quarter. So this is not a favorable backdrop for the economy at all. This prospect that the housing bubble deflates could be sort of the real fly in the ointment for the administration, who's really focused very much on providing interest rate relief, but also in promoting a business, a favorable environment for business. And I think basically all they've done to address the housing situation is this massive pressure campaign on the Federal Reserve to get rates lower. And if that fails, I think they're going to have an issue that they didn't expect to have thrown in their lap.
Yeah. All right. Well, look, we'll be talking about this a lot, I'm sure, Steph. So I'll move on from here in just a moment.
Sure.
But one thing, just a sort of a seed I want to plant with you, in case we do need to revisit it, is I talked with many of these ladies about a topic I know you and I have talked about as well, which is that the whole boomer wave we're now at some point in time we're going to get to the point where instead of 10,000 boomers are hitting retirement age a day, 10,000 boomers are aging out per day, and aging out is a polite way to say going to the nursing home or dying, right?
Right.
And that will presumably place basically at least a 2-decade headwind on the market as property comes on day after day after day after day from this, right?
You're preaching to the choir, because my parents just moved into a retirement community in Florida and put their home on the market in Palm Springs. So there's a perfect example of that. Those sort of communities, those retirement communities, and I assume, Palm Springs, places in Arizona, Scottsdale, whatever, Palm Beach, Naples, all those eventually will suffer from what you're saying, which is a deluge of inventory.
Right. So, I've asked over time, so when do you think this is really going to start to matter, right? When's it going to stop being academic and being actually practical? And interestingly, with Ivy, she was like, yeah, I really think, it's getting closer, but, probably by 2030, we'll start to really see it. Melody said, it's already here. And she said, I'm seeing it in the data. So point is even if it's 5 years away, that's not that long, right? But if Melody's right and we're actually starting that's a whole game changer in this whole housing market. And like I said, we can talk more about that in the future. But just one idea I want to plant in your head there, which is there is a ton of assets that the boomers own, right? And 70 trillion, I've seen different numbers, but let's say it's around there. And yes, there is going to be a massive transfer of that wealth to the millennial generation, and that will cushion the blow to a certain extent. A lot of people are saying, hey, look, everything's going to be fine because those assets are going to move from the boomers to the millennials. The millennials will then be spending it in the economy and everything will be propped up. And yes, there will be a ton of wealth that gets passed along. I'm saying I'm going to take the under on that, where I think a lot of that wealth is going to get either spent in the later years of the boomers, especially as healthcare costs and stuff go up like that, right? But also, I believe probably a healthy amount of that 70 trillion estimate is based on today's home prices, home equity values. So if the market actually does have a serious and sustained downward repricing, well, what do we want to shave off that 70 trillion? 10 trillion, 20 trillion, 30 trillion, right? There might just be a lot less to pass on.
And forget about a reversion to the mean of equity valuations.
Well, I was going to say, I didn't even mention a stock market crash and all that, right? Which could happen, right? Yeah.
So, Adam, I only have a couple minutes left because after this, I'm literally going to just flip over to recording with my partner in crime, Grant Williams, a quick conversation. So, and I know we're going to do one for you for your fall conference, if I can put in a little teaser for that, a plug for that one.
You beat me to the plug. Thank you so much on that. All right.
I just wanted to let you know that I've got 5 or so more minutes, but I don't want to prevent you from teeing up that big question that you teased earlier, because I'm dying to know what it is.
I very much appreciate you letting me know that. So I'll be very efficient here. And folks, I'm sorry we didn't get to questions from the group here. So
me too. I'm sorry.
We'll make sure we create a lot more space next time for this. Okay. So last key point, the dollar. That was one of the things we talked about going is there anything material you want to put on the board about the dollar? And I'll let you talk about it with the proper amount of time next time.
Yeah, no, I mean, not surprisingly, I think the dollar is headed lower in the long term. But there's that other side of it where, as we talked about with regard to treasuries, if you got this kind of knee-jerk Pavlovian flight to safety on any repricing of risk here, you might see a short-term bid to the dollar. Again, I would view that as a trading opportunity because it wouldn't be something that would be long lasting, and it wouldn't be long before everyone began to anticipate that we're going to have to not only cut interest rates more aggressively, but resume the expansion of the balance sheet. And that's going to be hugely negative for the dollar. And again, I just as an aside, looking at the dollar versus how it performs versus the yen or the euro or the pound, less interesting to me than how it performs versus gold. So you may see some short-term rallies versus, the yen or the euro, etc. But I expect that any of those rallies will belie a continued decline against gold in the broader scheme of things. So
okay, so investing wise, you're not making any changes to your gold allocation.
I'm not.
Okay, are you still shifting a greater percentage towards miners?
I guess I've pretty much held where I am, and have been enjoying having my my portfolio is naturally rebalancing itself given the move in the miners vis-a-vis gold. So I'm seeing that, the share of my portfolio that is represented by the miners has already increased just by dint of price appreciation. So I haven't had to make any additional allocation that way.
Okay. That's for good reasons, because gold's kind of hanging out, but miners are appreciating further, right?
Yes, absolutely.
Yeah. Okay, great. So real quick, the Taylor Swift thing, it's basically a throwaway, but what is interesting is I've seen some chatter on FinTwit about what's the economic impact of this going to be. So, I mean, you remember a couple of years ago, Taylor Swift's tour, like it was notable in GDP growth, right? It was so large revenue wise that it actually comprised a visible percentage of GDP. I think Beyonce hit a year like that too. So there's speculation that like, well, pretty soon then we're probably going to get the Taylor Swift pregnancy announcement. And so this is going to drive a wave of proposals and marriages and then baby spending and all this stuff. Do you think there's anything to that, or is that just, FinTwit being FinTwit?
Well, as I confessed earlier, I'm really not the person to ask this question because I have no knowledge of Taylor Swift and her whole world. So, I mean, it sounds like it's a huge thing. Although I would point out that, she weighed in on politics, and that didn't seem to have an impact on the political outcome. So who knows? But, I saw a clip last night about one of I think it was CBS or NBC News reporters on air when she saw the post that Taylor Swift was getting married, and she just completely lost her cool, on camera. So if it's that level of excitement, you could see, sort of a wave of little copycats. But I do think, I mean, my only insight would be that one that, she didn't impact the election, even though she attempted to. So we'll see how long her coattails are with regard to pregnancy, and who knows? I thought you were going to say maybe they'll televise the wedding, and that'll be some huge, thing for people to get into.
I think that's probably quite likely because they'll make $1 gazillion on it if they do.
Right.
But anyways,
maybe it'll be the halftime show at the next. What is it? Kansas City? Is that what he?
Yes,
yes,
okay. The Chiefs. That's where Travis Kelce plays for it. Yeah. All right. So, but anyways, just punchline. You're not holding your breath that Taylor Swift is going to save the economy.
I guess not. Sorry to rain on everyone's parade.
Well, look, I'm going to let you go in just a second to get to Brent. To just very quickly, Steph, want to put up your Twitter handle here for anybody that wants to follow you on Twitter at @Pomboy. And then obviously, folks, if you want more Stephanie in between her biweekly appearances here, and I highly recommend you get more Stephanie in your life, go to macromavens.com. I've got the URL right up there on the screen to get anything and everything related to Stephanie. But, actually, Steph, thank you. We featured one of your recent reports in last week's Macro Pass for our premium Substack subscribers. Got a ton of great, wonderful feedback from that as expected. But folks, Stephanie's She does a lot of institutional research, but she also does research for the retail audience over at Macro Mavens, and it is a must read. So highly recommend you go over and check that out.
Thank you, Adam. That's very generous of you. I appreciate it. And I am looking forward to, this isn't what Grant and I are recording now, but we'll look forward to reconvening for your fall conference, which it's hard to believe it's September already, because that's coming up really quickly.
I know. Technically, it's not September yet. We got a couple of hours.
I guess so. I'm pushing it, but we're pretty damn close.
But it is amazing how fast it's coming up. Yeah. And just thank you for reminding the audience. I'm super excited. Yeah. And very happy that you and Grant are joining forces. And so you'll actually be talking with each other. I won't even be in the picture for your segment, which I'm sure the audience is thrilled about.
Oh, stop.
No, but folks, it is going to be a great conference. And I guess just want to remind you, if you want to go to it, which this looks like it's going to be the best one we've ever done and very timely from a macro standpoint, get the early bird price discount while it's being offered. So go to that thoughtfulmoney.com/conference URL so you can lock in that lowest price. And if you are a premium Substack subscriber, make sure you check the emails I've sent you that have at the bottom of it the discount code to add, because you'll get an additional $50 off of the conference. Can't thank you enough, Steph. It's always so great to have you on here. Just one last URL for folks. If you want to get some help from a professional financial advisor to try to figure out how to navigate what might happen in the future should Stephanie's forecasts indeed come to pass, just fill out the short form there at Thoughtful Money, and you can talk to one of the advisors that comes on this channel with me every week for free. Steph, please say hi to Grant for me. Thanks for coming on. It's always so wonderful talking to you.
It's my pleasure. Thank you so much, Adam, and have a great rest of your week.
Thanks. And I didn't hear it this time, but please give Wilhelmina a scratch for me.
I mean, she's snoring like crazy over here. I said a truck driver last time and people were offended about, I don't even know how a truck driver snores, but whatever. She's snoring loudly. She says hello in her dream.
Right. Thanks so much, Steph. Talk to you soon.
Have a great week. Bye.
And everybody else, thanks so much for watching.